Now the final one, which is the third category, is what we call the fair value through other comprehensive income. And fair value through other comprehensive income, it means that the changes in the asset value goes through the statement of other comprehensive income. So instead of it to go through profit or loss, no, it does not. It goes through other comprehensive income. And one thing to take cognizance of here is that it does not apply to derivatives. We mentioned that for derivatives are always in the market, and hence they are always being traded. As a result of that, they go through fair value through profit or loss. But fair value through OCI doesn't concern derivatives at all. The only time it may concern derivatives is under hedge accounting, which is a different ballgame entirely. Now, for fair value through other comprehensive income, it applies only to an investment in equity and debt instruments that are held to sell and to collect. For what this means is that, we mentioned that for amortized costs, you don't plan to sell it, you just plan to collect cash flows from it. And what that means is that you are waiting till maturity for everything to play out. For fair value through profit or loss, you are not planning to wait till maturity, you are planning to sell. So the middle ground is the fair value through other comprehensive income, which is saying that you are holding it to sell and also to collect. And what that means is that at any point in time, you may decide to sell or not to sell it. So what this means is that we are tracking the intention of management about the financial assets and liabilities that is holding in order to determine whether we are categorizing under amortized costs or under fair value through profit or loss or under fair value through other comprehensive income. I made some videos that I will also include as links for you to actually watch to get a better understanding of these items that I'm explaining. And so for debt instrument at fair value through other comprehensive income, entities will need to track both amortized cost and fair value, because we said that fair value through OCI is like the middle ground. And what that means is that it is taking some aspect of amortized cost, it's also taking some aspect of fair value through profit or loss and combining it into one. And so the way fair value through other comprehensive income works is almost like it is taking amortized cost and fair value process together. So you will see how that works in the example after now. Now, examples include bonds with investment period likely to be shorter than maturity. And examples of that is a situation whereby you have a 10-year bond, but you plan to sell the 10-year bond at any time within that period. So if you plan to do that, then most likely you measure a fair value through other comprehensive income. Another thing is that when you have an investment in equity that you don't plan to sell, that you have the intention to retain. So for example, you invested in the shares of Apple and you decide that no, I'm not selling it at any point in time, then most likely what you have will be categorized under fair value through other comprehensive income. So let's take this example to see how that actually plays out. Okay, so it says here that on 1 January, your bank bought a 10-year corporate bond at $1,000 with a coupon rate of 10% and measures the bond at fair value through other comprehensive income. At year end, your bank could only sell the bond for $750 if it were to sell it. Your bank determines that the 12-month ECL on the bond based on the bank's impairment model is 120. So if you walk through this example, you see that the opening balance is the $1,000. They have an interest rate of 10%. If you remember that under the fair value through profit or loss, we didn't mention interest rate because interest rate is basically for amortized cost. Yeah, but when it comes to fair value through other comprehensive income, it has a characteristics of both amortized cost and fair value, and that's why we're talking about 10% interest rate here. The $1,000 is the opening balance, and then we are seeing that at the end of the year it fell to $750. But we now notice that there's an impairment of 120. Remember, we said there's no impairment that needs to be considered under fair value through profit or loss, but under fair value through other comprehensive income, we are considering the fair value of 750 that has changed from 1,000 to 750, meaning we are considering the difference of 1,000 and 750, which is the 250. If it were to be under fair value through profit or loss, the old 250 will just go straight up through profit or loss, meaning we just debit our profit or loss with that or credit it depending on where the debit and credit should go to. Yeah, if you look at the previous one we did. Now, but for fair value through other comprehensive income, that is not the case. We also need to consider the impairment of 120. So what that means is that the $250 that represent fair value that is supposed to go to profit or loss, if it were to be under profit or loss, will not go fully to profit or loss. So that $250 will now be spread between the profit or loss and the impairment of 120. So you see that in the next slide, how go about that. So the initial adjusting entry will be, we already know, we debit the financial asset that we've bought, we credit cash that we released out. Now at the end of the year, because we said there is a 10% interest on it, it means that we would have said credit interest income and debit cash with that 10%. Now if you look at the ECL recognition bit and look at the reconciliation that we have, you will see that we said the bond purchase is $1,000 and then the bond at the year end is $750, meaning there is a fair value change of $250. Now that fair value change is split between impairment loss and other comprehensive income, because we are saying we are measuring this as fair value through other comprehensive income. So the impairment loss will be $120, which is part of the fair value changes, and the remaining difference of $130 goes to other comprehensive income. And if you look at the adjusting entry for that ECL portion, what we are doing is we are debiting impairment loss of 120, we are debiting the OCL 130, and we are crediting the bond with 250 so that the bond can reduce to $750. So that's pretty much it about the measurement categories under IFRS 9 financial instruments. To learn more, I'll put the links where you can actually watch and get more explanation with respect to that. So that's pretty much it about measurement categories under IFRS 9. I'll see you in the next video where we'll be taking the advanced classes that has to do with our IFRS 9 financial instruments. Cheers.